All right, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounders with Cheese channel. In this video, we're going to be looking at the companies that are reporting their earnings this week. And the earnings is essentially their financial progress or how they've been performing for the past 90 days. And if you are a shareholder of any one of the companies that you see on your screen right now, it would behoove of you to keep up to date to see what their guidance is looking like, what their future is looking like. And this is something that I do on my own, like every single Sunday or Monday morning. So I thought to myself, why not just film myself thinking out loud? Now, obviously, my face is not on the screen, but if that sounds good with you, let's go ahead and look at each day of the week in a little closer format. So to kick things off on Monday, September the 15th, can you believe we only have 3 more months to go until the year is over? Dude, it blows my mind that 2016 is almost a decade ago. Like, come on, dude. Why is time flying? But anyways, I think the only one that really sticks out to me here is Dave & Buster's, ticker symbol PLAY. Now, this is essentially a restaurant establishment where they also have an arcade that's kind of designed and catered towards the adults. And I think this is one of those rare business operations where it's kind of like a third place. However, as you can see, in the past 1 year, they're down by 24%. And I say it's a cool concept because I think leading up to the 2000s, like 2010, 2011, I think as a society and as a civilization, especially here in the US, we used to integrate a third place into our schedules, right? Like the first place is your home, whatever that is, whether it's a condo because you're divorced or a single family house. And then the second place is obviously where you go to work, whether it's at a building, a warehouse, a facility, whether you're an Uber driver. And the third place is basically where you go in between those hours, where you go to hang out, where you go for to establish relationships in your community. It could be in the form of like, I don't know, a bar, a cafe, the church, right? And I feel like all 3 of those places that I just listed, they're kind of declining, right? Our participation in the church, the numbers aren't like they used to be in the past. And I think up until like the 1940s and 50s, the barber shop is where a lot of men used to hang out. Not really a thing anymore, especially when they're charging like $200 for a haircut and you got to download their freaking mobile app and set up an online appointment. Like, dude, please stop. But anyways, Dave & Buster's is a company where, funny enough, during the pandemic sell-off, I invested big into them when they were about like $10 a share. Now, obviously, I didn't catch the bottom. And then once they rebounded to about $40 at this point right here, I sold out of them. And that's 2021, right? So fast forward to till today, I have not looked at Dave & Buster's in the past 4.5 years. And now here they are. And I'm like, wow, it's been a long time since I've taken a look at this company. And taking a look at, wow, since 2021, they crushed it up until recently. And now they're relatively flat and even on the decline. And so that's why I'm saying, like, I think Dave & Buster's is kind of an interesting business because of that whole idea of a third place. Now, the last time that I checked up on them, they had like this whole membership plan where you can pay a monthly fee to have an allocated amount of coins or tokens or whatever so that to, I guess, encourage you to be a repeat customer and go to their restaurant, eat out, and then play in their arcades. I think that game plan is still intact because I don't know why. About a month ago, I looked into Chuck E. Cheese, which is basically the exact same thing as Dave & Buster's except for the little kids. If you're like 9 years old or 10 years old, exact same concept, right? It's a restaurant, but it's also an arcade. And I know this is an unpopular opinion, but dude, Chuck E. Cheese and their pizza, I still think top 3. Don't talk to me about New York City pizza being so great or New England, what do you call it? Freaking Connecticut pizza with clams. Dude, disgusting. Or Chicago pizza, get out of here. Chuck E. Cheese pizza, I'm telling you right now, so freaking good. But to circle back to Dave & Buster's, I mean, taking a look at their freaking balance sheet, dude, this is horrific. They have $11 million of cash on hand. And I'm going to tell you right now, their debt is probably outrageous. Are you ready? Total debt is $3.4 billion. So after accounting for the cash on the books, you still have $3.4 billion of loans. Not a pretty picture, and I guarantee they're probably negative free cash flow. You ready? So right now we're on the cash flow statement, and we scroll down. They go free cash flow, negative $272 million. So even though they present an interesting opportunity, dude, this company blows. I would not want to invest into them. Now, in the past 5 years, they're up by 43%. But if you bought into them at like $45 a share, dude, you would be down by like 50%. So, needless to say, let's move on. I think Dave & Buster's is an interesting third place, but, dude, their financials are just not, it's not presenting a pretty picture. We jump on over to Tuesday. We got Ferguson Enterprises. This is a really interesting company because they're basically the Amazon for plumbers and contractors and home builders. You go inside of a Ferguson website and you can order basically anything, pipes, HVAC equipment, and check this out. Past 5 years, they're absolutely a compounder. And this is only taking into account their share price appreciation, 125%. Look at their financials. Visually depicted, it's going from 20.8 million to what it is right now, 30 billion. It's a pretty sound company. And I want to take a look at what is their forecast right now. So scrolling down right here, if we break it down on a quarterly basis, let's see. The expectation is 8.5 billion for the past 90 days. Earnings per share should be $2.94. The growth expectation of being freaking 31%. I'm not gonna lie to you, that's pretty high expectations. Now, can they meet that? I guess we'll see. Let's see, 6.9% growth in their revenue. Jump on over to their income statement to see what they are establishing right now. Let's see, 7.6 billion, and the expectation is 8.5, right? And what was the Q4 numbers of last year? Just shy of 8 billion. Okay, I mean, they are trending in the right direction, and I think they are benefiting from the whole AI data center structure and landscape. So I want to be optimistic. I'm not a shareholder of them, so I don't have a bias. I feel like they'll be able to pull it off, but for their earnings per share to go from $2.07 to, what was it, like $2.65 or something, I feel like that's a really high expectation. I do not know. It's going to be $2.94. I don't know if Ferguson's going to be able to pull it off. And what I have seen is there's two things that usually causes a company to just go on a massive sell-off after reporting earnings. Number one is if they miss the expectations in the forecast, like, hey, we told you that we could hit $2.94, but we actually posted $2.75 of their bottom line per share. Massive sell-off, usually like a 5 to 15% little correction. The second thing that causes a company to go on a sell-off is their guidance. So even if they beat the expectations for that quarter, whatever they say for the next 6 months or the 12 months, laying down the framework of like, okay, this is the expectations for the rest of the year. If it's not juicy, if it's not beautiful, they can also go on a sell-off. For Ferguson, I'm going to tell you right now, their earnings per share, oh my gosh. Here, let me just show you visually what we're looking at. Oh, hold on, that's annually. I want to break it down on a quarterly basis. So Q4, it was $2.23, and they're saying $2.94 when taking into account how the past 4 quarters in a row have been negative and on the decline. I'm not a betting man, but I'm going to go ahead and assume that Ferguson is not going to be able to meet their bottom line expectations. I think it was a little too ambitious by the leadership team. I could be wrong, but I mean, based on the numbers that we just looked at, I think it's not going to be a pretty day for them on Tuesday. And then, you know what? I don't really know what these ones are, so we're just going to jump ahead to Wednesday. General Mills. Let's go ahead and talk about General Mills. Ticker symbol GIS. Now, this company, for the past 1 year, has been rough. They're down by 31%. And it's not just exclusive to General Mills, okay? If we look at any one of their competitors, like Hormel, negative 19%. We look at Conagra Brands, 39%. We look at, Smucker's, SJM, down by 8%. So the entire consumer staples sector is just taking a beating. All right. General Mills, I like this company. Full transparency, I'm invested into them. It's one of those things where it's like, I don't expect it to be the next NVIDIA. I'm not delusional. But if we jump on over and take a look at their dividend profile, a 4.8% dividend yield that's qualified and it's healthy, it's sustainable, and it's growing. It's basically like investing into a high yield savings account with the off chance that it could appreciate. So not only would you get the share price appreciation, but you also get a 4.8% yield on cost. So for me, I've been investing into it, but I've kind of pumped the brakes. I think as of July, I stopped putting any money into it. I think my average cash basis per share is like $52, $53. I only have a handful of shares, not that much. So I'm not too stressed out about them, but let's take a look at their financials. It's been relatively flat, right? Ever since 2023. Actually, that's dishonest. It's going from 20 billion to 19.4 billion. So they are kind of on the decline. So right off the bat, I can tell you, not a good thing. And if we go down to their earnings per share, is that improving? It's relatively flat, which is a good thing to see with an established, mature company. Free cash flow, 2.2 billion, relatively flat. It's sustainable and it's stable. That's the second best thing to a growth in their free cash flow. And I want to kind of see what the expectation is. It should be negative. So if we break that down on a quarterly basis, the expectation for, I guess, their fiscal year is Q1 2026, August 30th. Let's see. The expectation is that their revenue is supposed to go down by negative, oh my goodness. So their revenue, negative 5%, and the earnings per share, negative 20%. Okay, so there is literally no expectations for this company. So if they do surprise and beat the forecast and they post 83 cents of profits per share and their revenue comes in slightly higher at 4.6 billion, I think they could spike. And when I mean spike, I don't mean going to the moon. So they're 49.92. If they do post the positive earnings, I don't think it'll be crazy for them to pop like 5, 6, 7% and end the day at like 51, 52 bucks. But this is a company where regardless of how things go, in their earnings, I'm not going to sell out of them unless they make some crazy decision to change their business model to selling freaking, plain white t-shirts and saying, hey, we're exiting the grocery business. If they do something weird like that, I'm out. I'm selling out of them. But if everything's still intact and they're going to use the same message and slogan of inflation is hurting us, but we're doing okay, and their numbers are relatively flat, I'm just going to hold on to my handful of shares. Because in the grand scheme of things, 15 to 20 years, do I see General Mills and their products disappearing from the shelves? Absolutely not. But I think that is an interesting situation because people are still eating, correct? It's not like everyone is walking around deciding to lose 50 pounds for this year, right? I mean, you might on January 1st, but as a guy that has been going to the gym for a pretty long time now, after all of those New Year's resolutions folks give up, dude, by February 1st, the gym is empty. And so I don't think collectively as a society we're like, we're going to stop buying grocery items. But I think it dawned on me the other day during one of my protein dropping sessions, which is me sitting on the toilet. I thought about it and I was like, wait, so what's going on? Why are the grocery stocks selling off? And it's because their operations are declining. Like, what's going on? I started thinking about it a little deeper, and I think it might have to do with the fact that people are starting to buy the off-brand or the store brand product alternative. Because if you go to the chips aisle, for instance, like a Walmart, and you see the great value potato chips for like $1.99, and then you see the Frito-Lays manufactured by PepsiCo for $2.99. I think the consumer is they're reaching for the cheaper option because when you pull up the financials here, I'll just do it right now. If you pull up the financials for like Walmart, for instance, right, I think they're responsible for about 25% of all grocery sales here in the US, which is a lot, man. If we pull up their financials, they're crushing it across the board, right? And obviously that's baking in all of their other lines of business, like their retail items, like Walmart, the e-commerce arm of the business. But if we break it down into a grocery segment level, I'm going to go ahead and assume that their grocery is probably increasing. Oh, why does it look like that? Come on, where does it not have a grocery line item? Okay, there it is. So the grocery and consumables, it's growing at a mid-single digit rate, quarter over quarter, year after year since 2023. And I'm certain if I scroll over here, it's just nonstop growth, correct? So I think my investing thesis for the grocery items, I think they're struggling. But at the end of the day, a lot of these private brands, I mean, they're made by a few companies, right? Like UNFI is one of them. They manufacture grocery items for the store itself, but instead of putting UNFI on the label, it'll say like Target, it'll say Walmart Great Value or Costco. And another one is this one, Treehouse Foods. They also do the exact same thing, but for the most, why are they going on a massive sell-off? 57% in the red for Treehouse, and then UNFI, they're up by 101%. So I guess they're crushing it, whereas Treehouse is struggling. But I think the point that I'm trying to make is when it comes to these private brands in the grocery stores, they're also manufactured by the big boys. So case in point, when you think about the Costco laundry detergent, the Kirkland brand, I think for the longest time, their contract was with Henkel's Purcell, but I think they just changed it to Procter & Gamble. So now the Kirkland laundry detergent is actually tied in disguise. It'll say Kirkland, but it's actually tied. So case in point, what I'm trying to say is like with these grocery private brands, I think Walmart is not making any of it, okay? They're outsourcing their contracts to these food manufacturers so that the Great Value label can be printed on it. So I think even if the established brand itself, like Cocoa Puffs or Frito-Lay's chips, even if that declines and people start buying the Walmart alternative, they're still buying it from Frito-Lay's. They're still buying it from Conagra Brands. So I think, man, I don't even know where I'm trying to get at. I guess what I'm trying to say is I think the grocery food stocks, I think their growth story might be pretty small and negligible going forward, but I don't think they're going to go belly up. Does that make sense? I don't think as a society we're just going to stop eating. So, yeah. So General Mills, hopefully things go well. I mean, look at this. The expectations is for the revenue to go down by 7%, 25%. There's no expectations from Wall Street. They just have to not commit a crime or a scandal and they'll be okay. So I think they'll be flat by the end of this week at about $50. Calling it, okay? And then, wow, check that out. Manchester United. Yeah, can you believe that they're a publicly traded entity? I'll tell you what, man, I'm a huge soccer fan, but never would I want to invest into a freaking soccer stock. It just doesn't really make sense to me. I mean, like, I don't know. Let's take a look at their operations, okay? Okay, I mean, the top line seems coherent, but it's unprofitable, okay? Unprofitable, and I think there's a lot of debt on the books. From what I remember, $73 million. I did take a look at them about a year and a half ago, and then I was like, oh my gosh, their financials are completely trash, especially for a business operation that does not have overhead costs of producing a hard good. They're not manufacturing crap. They're selling tickets to their games. They're selling the idea of being a part of the Manchester United community. So in theory, their books and their numbers should be rock solid, like a consulting firm. But their numbers are just complete trash. So Whether that's not me saying that because I don't support them, okay? I'm saying that objectively, it's just not a wise idea. I would not invest into a sports team. Now, having said that, I think one arena, I guess that's a play on words, that I would invest into that's involving sports. It's not NASCAR, it's not baseball, but it's TKO. It's the parent company of the UFC and WWE. Now, as a kid that developed body dysmorphia because I used to really like WWF, this is a company that I would consider because, just look at their share price performance, 98% 5 years. Sorry, not even 5 years because they just debuted on the stock market in 2023. So 2 years, 98%. And their revenue looks a lot better than Manchester United. Can you believe that? UFC, especially with the pay-per-view and the idea of whenever they have a fight night, whether it's in Las Vegas, Saudi Arabia, wherever it is, it's always sold out. I think MMA, as a guy that likes the sport, I think MMA is only going to get more popular as time goes on. Now, they just started to become profitable as of 2023, which is when they decided to do an IPO. And now it's improving by a significant amount, $2.59. What I'm curious about is so they have $500 million on the books. Total debt, $3 billion. So they're in the red by $2.5 billion. I don't think they pay a dividend. Oh, they do pay a dividend. That's the most hilarious thing. The UFC pays a freaking dividend. So, having said that, I wouldn't invest into a soccer team. I wouldn't mind pulling off something like what Tom Brady is doing with Birmingham, or Ryan and that other actor with Wrexham. I wouldn't mind buying a team, but investing into them as a shareholder, probably not the wisest use of your capital. And if we... there's also Cracker Barrel. Dude, this is a company, embarrassingly enough, in 2018, 2019, 2020, dude, I went balls deep into them and they made me a pretty penny. And it's a restaurant establishment that's kind of reminiscent of the past, of the 1800s. You go into their restaurant and they'll have paintings from the Wild West. You'll have a bear's head that's stuffed. It's an old school restaurant, and they sell old Southern cooking, country fried steak, waffles, stuff like that, right? And check this out. So when I was invested into them, it was around this time period right here, and they made me a lot of money. And their dividend was absolutely juicy. But if you take a look at them, ever since the pandemic, they've just been struggling. And what I mean by juicy is, take a look at their dividend. They used to pay a special dividend. Look at that. So not only did you get $1.10 every 90 days, but you also got $4.40 out of the blue. And then another one, bam, bam, bam. That's when I was invested into them. But then, I don't know what happened, but I think in 2020, I made the executive decision to completely sell out of them at a pretty big profit and then to buy into Texas Roadhouse. And I'm going to be honest with you, that was a really good play. And I think that was pure chance because at the time, 2020, I think I saw their first hint of pain. And then I was like, I wonder if this is going to be a trend or if this was a one-off because of the pandemic. And I decided to just jump ship. And I want to see their bottom line per share as well. Yeah, they were negative $1.36. I jumped ship and I went to Texas Roadhouse, and my Texas Roadhouse is up by almost 150%, taking into account the dividends as well. Cracker Barrel, dude, is just... I feel like they're having an identity crisis because I think it was last month, their marketing team decided to debut their new logo and they made it really flat, right? They got rid of the little cowboy with the whip and the barrel and they just decided to make it look like a Denny's logo. To be honest with you, wasn't exactly the smartest PR decision because if you went to their Instagram, dude, everybody was like, what are you doing? Bring back the old logo. And sure enough, they actually listened to the customers and they brought back the old logo. But speaking of their menu and everything like that, I think their food tastes phenomenal. It's sad for me to see what's happening to them. Because As you can see, I mean, since the pandemic, they've just been increasing their top line year over year, and they're doing okay. It's just they're missing the expectations again and again for every earnings call that I tuned in. It's just, I feel like their leadership team is not they're not steering the ship in a proficient manner. Because I feel like their food is phenomenal, and they're executing on the financial end of the bargain. It's just the leadership team just does not know how to sell the business into the eyes of Wall Street and to potential investors. To be honest with you, this is a hot take. As a guy that's still invested into Texas Roadhouse, if I had to pick between the two, to be honest with you, I can't say that I would pick Texas Roadhouse every day of the week. I'm not investing into Cracker Barrel, but sign me up when we talk about their burgers. Sign me up when we talk about their breakfast menu. So freaking good. But I think back in 2023, I think I made a deep dive analysis video about Cracker Barrel. I uploaded it onto the channel. And I talked about how their core demographic, which are people above the age of 65, they just stopped going back to Cracker Barrel. And I think they made their way into Denny's and IHOP. For whatever reason it is, they just stopped going back to Cracker Barrel. And now they're scrambling, and this is 2 years ago, so I don't know if it's still the same, but I'm assuming it's still the same. They're scrambling right now to resonate with the millennials, which pound for pound, as an age demographic, if you're between the ages of like 31 to 49, we eat out the most. And they're losing that battle right now. And I don't know, it's unfortunate to see. I really hope that Cracker Barrel does not go belly up, but I guess only time will tell. And another thing about Cracker Barrel is that they're usually not located in like a downtown urban area. They tend to strategically open up like 3 to 5 restaurants. Yeah, that's it. Only like 3 to 5 per year. Usually on the highway travel destinations. They'll be in the middle of nowhere. So it's usually predicated upon the travel industry thriving. And from my understanding, with everything that's going on in the US, apparently one of our biggest tourists, obviously, is from Canada, correct? And the Canadians have just stopped coming to the US in 2025 because they're scared of all the ramifications that could happen to them. And I think that's something else that's going against them. And if we sashay our way to Thursday, September the 18th, after the markets close, we have FedEx that's reporting. And I talked about it. I don't want to come off like I'm a jerk with small feet, but I recently uploaded a video, stocks that are not buy and hold forever, and I talked about UPS. I think I went on like a 10-minute rant, and hold on, my dogs are going absolutely crazy towards the neighbors. One second. My wife has been giving away all of her garden plants, vegetables, and fruits because she's 8 months pregnant and she knows she can't take care of them anymore. And our neighbors have been coming by the house all morning and the dogs are going absolutely bonkers. Like, get away from us, get away. But anyways, in that video, I talked about how FedEx is the much better alternative, and I think their future looks a little bit brighter than UPS. And I think it boils down to the leadership. I think UPS and their leadership team have very questionable decision making that they're doing right now. I have zero confidence in UPS. FedEx is the better alternative, but if I had a choice, as a guy that my last position in corporate America was actually in the supply chain space. I was a director of our operations for a huge company that I try not to talk about too much on this channel, but as a guy that had a huge line of sight into the logistics space, I would not invest into either FedEx or UPS. Believe it or not, I think Amazon is the clear winner going ahead. Yeah, I know. Crazy to say that. Now, I do not think UPS and FedEx is going to go away anytime soon. But I think we have started to see the fall of their dominance. I think they're still going to be a player, but I think their market share and their impact on the supply chain space of delivering stuff is going to just get smaller and smaller. On the other side of that argument, I think Amazon will only get stronger and stronger. And I'll just leave it at that. And then we also have Lennar, which is a home building manufacturing company here in the US. And year to date, I mean, their 1 year is pretty rough. 5 years, all right, now we're talking. But as you can see, it's a very cyclical company. There's highs and lows baked in. And I guess after the Great Recession, they went on a massive sell-off. And if you bought into them at about $60 in 2005, it would have taken you quite a while to break even. My goodness, it would have taken you up until about 2017. But for my understanding, I'm not a real estate guy. I'm not even going to pretend I'm a real estate guy. I'm a guy that understands the pharmaceutical space really well. I understand the supply chain space, and I understand the equity market, right? Stocks. I do not know too much about random commodities like the price of gold, oil barrels, and I'm not even going to pretend like I understand real estate, okay? I just know that right now we're in a seller's market, and people from California, they're willing to pay 50 to 100 grand above the asking price, which effectively means I can never buy a freaking home. But anyways, Lennar, here's the thing. I think in the US, we do have a housing shortage because I think there's a lot more people that would rather own a home than rent. But because of the availability and desirable locations like San Diego, San Francisco, New York City, who else can be thrown in there? Chicago, right? To buy a house or property in those areas that I just listed, dude, it's so freaking expensive. But I think their future, Lennar, I think they'll be okay. But for me, I don't want to invest into them because they're too cyclical. Meaning, the housing demand and boom comes and goes in cycles. It's not every single quarter or every single week that their demand is going to be exponentially high. But I mean, based on their top line, what I just said goes right out the window because, I mean, that looks phenomenal. But I think it shows a clear picture. Like, as you can see, the demand went up in 2018 and then it stayed relatively flat. And then during the pandemic, the demand went up and now it's relatively flat. So I think it goes in cycles of like high demand and then it just kind of fizzles off, but it's not like it erodes. So it's a cyclical space that I'm personally not interested in. And plus their dividend profile, actually, that's a pretty decent dividend profile, but it's just not something that I would want to invest into because I don't really understand the construction and home manufacturing space. I mean, obviously I can take the time to get to know it, but that's just, not my cup of tea. However, also on Thursday, we have Scholastic. Dude, do you remember the Scholastic book fairs that used to come to your elementary and middle school to sell those books? Dude, time of my life, except I was never able to buy any of the books. But just going in there, so freaking fun. But would you realistically want to invest into a book publisher in the year 2025? Honestly, probably not the wisest idea. Surprisingly, they're up by 111% since 1992, which is kind of hilarious. Relatively, they had some success. Oh my gosh, can you believe the folks that bought into Scholastic in 2002 for $54? Dude, if they held on through all these years and the ages, they would still be in the red. So it's like, Scholastic, you're just not for me, friend. And if you bought into them during the recession and they were, gosh, come on, roughly like $10 a share, I guess you would be a happy boy. But let's be real. A book publishing company in 2025, probably not the smartest move. And then we also have Darden Restaurants. I'm not shy about it. I love this company. Super high quality. I love their portfolio of brands. Let me see if they have, oh, they do. Olive Garden, Longhorn Steakhouse, Cheddar's, Yard House. Yard House, not too bullish about, and same with these ones. But bullish about Olive Garden and Longhorn Steakhouse. I love them. But I'm not invested into them because I think they're too expensive right now. At 212, and they're trading multiple at a 23. Just not the wisest choice. I feel like in the restaurant space, I mean, I'm invested into Papa John's, but I feel like they would be a better alternative, but they're also at a 22, and they're pretty darn expensive as well. I'm trying to think of another one that might be relatively a good deal. Let me think about this for a second. McDonald's is also very expensive right now, and I would argue Domino's is as well. Yeah, I think the only one that might be cheap right now, but they're cheap for a good reason, is the Wendy's. Yeah, their PE is a 10. They're basically priced with no growth factored in. But between you and me, would I want to invest into Wendy's despite the fact that they have a phenomenal breakfast menu? No, I would not. But surprisingly, their financials are pretty solid since 2017. Their top line has been growing. What about their bottom line? Bottom line has been pretty stable. Talk about their dividend profile. I think that's where it gets a little ugly. It's a 5.8%, and I'm pretty sure they just cut their dividend. Yeah, they just cut their dividend during the pandemic, and they cut their dividend again in 2025. Like I always say on this channel, stay away from dividend cutters, because once they cut that dividend, it's just only a matter of time before they cut the dividend again. And it's just, when you cut the dividend, it's because it's a reflection of their operation struggling. Because if their earnings per share is not going up and on a stable rate, they have to cut the dividend. And as you can see, it goes up, it goes down, it goes up, it goes down. Just not a very reliable restaurant establishment, in my opinion. Now, if we go back to the earnings calendar, is there anything else? Fridays are usually very quiet, and it's no different. So, some announcements I want to make before I sign out of here. I'm going to be launching the portfolio roasting / reviewing series very soon. And dude, I'm pretty excited. I think it's going to be really fun, especially that way we can look at each other's portfolios and be like, why is this dude that's the same age as me, why is he invested into Ford Motors? You know, like, we could talk about it. It'll be a fun thing. So be on the lookout for that. And then prior to making this video, I watched Tottenham just beat the rails off of West Ham. Dude, we won 3-0. It was the first game that I saw Xavi Simons play in. I only watched his highlights on YouTube. Besides that, I was like, I don't really know how good of a player he is. He is worth the hype. Dude, that guy, I love him. He's amazing. Realistically, the game should have been 4-0, but they took away this goal from Romero, like, in the first, 10 or 15 minutes of the game. I thought that was BS. But what's new, right? The Premier League refs, they suck. And then, talking about the third place, something I want to share with you is one lesson that I learned, especially from reading various financial books, listening to a lot of podcasts, it's this concept, okay? I don't know where you are on your financial journey, but I think it might resonate with you as well. Don't just retire away from something, such as your job, but instead you want to retire towards something. Because the saddest story that I hear about is when people work 30, 40, 50 years, they quit their job and then they croak the next week. Right? It's because once you retire, you just lose that sense of purpose, schedule, your eating habits get out of control, you start drinking and you go crazy and you get wild. But after you retire, I think the better choice is to go towards the next endeavor. Obviously not something that's going to take a toll on your soul or is stressful, but maybe it's tending a garden, you know what I mean? Or maybe it's running a bread and breakfast. I'm just kidding. Don't do it. Apparently it's super stressful, razor thin margins. Or maybe it's, spending more time with your grandkids, going fishing, whatever it is, right? Me, personally, I think once I retire, dude, I'm so far away from my goal of reaching fire, but you got to be ambitious. You got to be consistent, disciplined, steady. I know I'm going to fire one day. It's just I'm nowhere near it. Anyways, when I retire, what I'm retiring towards is I'm trying to open up a bookstore with a board game cafe that sells healthy drinks like smoothies and whatnot as the heart and soul. So that's what I plan on retiring towards too. And I think it'll be fun. Obviously, it'll be a little hard, but I don't even care if it's going to be profitable or not. It's an establishment where I'm going to film future YouTube videos in. So the background will be bookshelves and everything. It'll be cool. But it'll also be a place where people can hang out as a third place. So that's what I plan on doing. Anyways, hey, I love you guys. Thanks for tuning in. Thanks for engaging and commenting. I really appreciate it, by the way. And I hope you have a good rest of your week. Stay safe. Good luck in the stock market. And I will talk to you really soon. See you guys.